Hello there, and welcome to the Kluge Wealth Advisor Group Connections video for October 2025. In this month's video, we're going to touch on a number of topics, including a portfolio and market update. We're going to talk about some estate planning considerations for digital assets, as well as touching on your frequently asked questions. Now, before we get into all that, there are a few housekeeping items I wanted to touch on. The first one was just a reminder that if you do want to be in touch with the team and set up a specific time, please use that book a meeting button that you find at the bottom of every single email on every team member's email signature. If you use that, it will connect right to our calendars and you can book yourself right in. The second thing I wanted to talk about is that if you're managing your tax installments, we were able to produce an up-to-date realized gain and loss report to help you manage those payments. The third is that we are looking at doing a client event in May. Now, this would happen on a Friday evening, and we just want to solicit some feedback from each and every one of you about whether you might be potentially available for a Friday evening client event. And finally, just a quick reminder that as we get into the end of the year and many of you are thinking about charitable donations, if you are thinking about making a donation, it's always a good idea to do that in kind or donating appreciated shares versus in cash, because that allows you to avoid the capital gains tax on those appreciated shares. So you can do that at any time, and it's always just a quick consideration as you think about potential larger gifts. Now, let's go get right into our monthly video. In terms of a portfolio update, the bottom line is that October was another positive month for portfolios. This is good news, and we want it to keep coming. So unless something truly happens that's untowards over the next couple of days, this being videoed on Wednesday, October 29th, we're going to have a great month, and cheers to that. Now, we did take a couple of actions over the course of the month. We did redeploy some cash that we had raised earlier in the fall by taking profits on Palantir, Oracle, and Broadcom, and redeployed it into a few names, including Goldman Sachs and Applied Materials. Now, speaking of Goldman Sachs, there was an interesting phenomenon that I did want to note that has occurred over the last 6 weeks, and that there's been a very, very heavy rotation out of high-quality stocks into low-quality stocks. And so we have seen some truly extraordinary performance out of some securities that are really, truly quite low quality. Now, this is not a warning sign or anything truly untowards. This is a normal part of the market, but it also is just something I did want to note, and that's, it is another sign that the market is beginning to discount strength going forward. You don't want to buy companies that are financially weak if you believe the economy is going to slow down. You want to buy them if you believe the economy is going to speed up. So I think that's another good sign and a good read through for us as we look through to November and December. In terms of a market update for October 2025, this one is going to be short and sweet. As I'm videoing things here on Wednesday, October 29th, we're not experiencing October, we're experiencing an Uptober. That's always good news. Markets have been strong. We did see a little bit of a correction mid-month around some US-China trade tensions. However, that quickly dissipated and markets resumed their march higher. So bottom line, strong month. October was really an Uptober. And again, we fit in with a pattern of October and September being strong when you have a big spring correction. That pattern has continued here, and hopefully that bodes well for the rest of the year. Now, before we get into touching on your frequently asked questions over the course of the month, I did want to take a few moments to talk about digital assets and estate planning. So digital assets are becoming a hot topic in estate planning because of how prevalent they're becoming. Now, we always have to start with the basic question, what is a digital asset? And in an estate planning context, a digital asset can be any property you have that's electronic. It could be, for instance, digital media that you've purchased, such as songs on iTunes. It could be software subscriptions. It could be photos in your cloud service. It could be your accounts on LinkedIn, Facebook, Instagram, or it could also be tokens in a self-custodied crypto wallet. So with all of these assets, it's very important to remember a couple of key things. The first is to inventory them. Make sure that your executor can find out that they exist. They can have a lot of value, especially if you're thinking about something like self-custody crypto tokens or airline points. Those can have a lot of value for your heirs. The second thing is express your wishes. Do you want them to be shut down? Do you want the service to move on to somebody else? Do you want the asset to be liquidated, or how do you want them handled? And finally, make sure that you're keeping your passwords in a secure online storage vault, and that your executor has access to that vault. So they're able to administrate your digital assets and preserve their value. Now, this is an emerging area of conversation, so if you do have questions on this, we are here to help and happy to have that conversation with you. Let's get into talking about some of your frequently asked questions over the course of the month. Now, like last month, there was a single recurring theme that dominated conversations over the course of October, and that was really questions around, are we in a bubble? Is the market going to crash, etc. So again, the short and sweet or too long didn't read answer is that based on looking at the entire case, I do not believe that we are in a bubble, and I do not believe we are headed for a market crash at this point. Now, I believe that these things are possible because this is the world we live in. We are in a high volatility, high return market, but I don't believe we've checked the boxes that you need to see for a bubble to form. And I don't think that we're in a situation where it's very likely that markets will crash. So we're going to go into that in more detail in the following segments, but I did want to give a very quick bottom line read to those who want to see a quick answer on this one. Again, if you're interested in more detail, there'll be some more segments on this coming up following this one. Okay, so before we get into directly answering questions about, are we in a bubble or not, and looking at the case that you can make, I did want to make a comment about the general atmosphere or the general landscape that I'm seeing. The bottom line is that almost every client conversation I'm having with anyone who's consuming financial media, these conversations have all revolved around this idea that we're set up for a market crash, or that we're in some sort of a bubble, and that ultimately it's going to lead to a huge destruction of wealth. This has led some observers, including the famous strategist Tom Lee, to of course remark that this is the most hated rally. I can see this anecdotally through my client conversations. I can see it through research providers I have that also provide their anecdotal experience about their meetings with institutional clients who are also quite negative. And you can also see it in the statistics, whether it's the number of bullish advisors out there, or whether it's the number of bullish individual investors out there. There's a deep skepticism that's pervading the market. So I think it's important to note this, and I think it's important to note that that is the current narrative. Now, narratives shift, and we also have to remember that narratives have frequently been wrong, right? The narrative in April of this year was that tariffs would cause a recession, they would cause a spike in inflation, and that interest rates would go higher. And what we're seeing is frankly the exact opposite. Inflation is not trending higher, interest rates are lower, and the economy, US economy at least, is picking up steam. So we always want to put things in context when taking a look at the landscape and saying, is this a narrative? Because if it's a narrative, there's a good chance that it's going to be wrong, because that has just been the history of these things. Now, in saying that, I want to acknowledge 100% that no one's going to be surprised here when I say, look, I don't think we're in a bubble. I want to acknowledge that I can be wrong, and I want to acknowledge that I've taken the time to understand the arguments of those who are arguing for it. If you want, and I would leave this as an open invitation for everyone watching this, pick up the phone, give me a call, I will scare the pants off you. I will make a very forceful argument about why you should liquidate every asset you own and head for the hills. So I don't think this to be true. I think it's a bad argument. However, I've taken the time to understand it so that I can credibly bring you the other side of the equation here and work to make the best decisions we have for you, your wealth, and your future. So, before we get into talking about whether we're in a bubble or not, I did want to take a moment to define what a bubble is, because this term gets thrown around pretty casually, and I want to make sure we're being pretty precise about what we're talking about here. The bottom line is that a bubble is when the price of an asset becomes completely detached from the value that it's providing. And we've seen a number of these type of bubbles through the course of financial history, starting with the South Seas bubble, the Amsterdam tulip bubble. We saw the electrification bubble, which led to the 1929 stock market bubble. There was clearly a bubble in US housing. And then we've also seen mini bubbles in Canadian marijuana stocks and US biotechs. So again, they're not very frequent, but they do occur, and it's something that as investors we need to be mindful of. One of the things about a bubble is that it's very, very hard to see that you're in a bubble until after. And the reason for that is that bubbles are usually caused by new or emerging industries or technologies, whether we're talking about railways or canals or overseas trading companies, or internet stocks, it's always proximate to a new technology or a new industry. And the reason why you can have a bubble get created is that nobody knows what total addressable market is, or TAM. And if you don't know TAM, things can get out of hand. Now, we do have a similarity here that I'm just going to point out very, very broadly. It is very obvious that blockchain technology and AI is a new technology, and that nobody knows TAM, which is why I'm going to forthrightly state that if you put a gun to my head and ask my opinion, I'm going to tell you that we're going to get into a bubble with AI. It's just years away, but we will get there. So let's move on to talking about why I don't think we're at a bubble stage yet, and what the signs that we're going to be looking for as we move forward. So, addressing the question of, are we in some sort of AI bubble or blockchain bubble right now? The bottom line is, even though I've assessed the arguments for, I have to come down and say, the bottom line is I do not believe this to be the case. Now, we don't believe this to be the case for a number of reasons, right? The first is that at an industry level, we have never seen any single one of these cycles of investment in capital stock, right? Whether, again, you're talking about electrification, railways, canals, internet telecom companies, this is all building capital stock. We've never seen one of these cycles end when the return on invested capital is positive. Now, currently, if you look at what's happening, we can see that Microsoft, according to its own annual report, has about a 67% profit margin on its data center business. So that is so far from being in a negative position that we literally have to think about this being years from now, if we're even entering into that sort of a situation. Now, the other thing we have to think about is the sheer volume of investment in capital stock has typically peaked at around 6% of GDP. And based on a number of sources that I have, we can see that the capital investment in the United States is about 2% of GDP. So we probably actually have to see about 3 times the annual rate of investment to really get into that, air quotes, that bubble stage. So if we're going to evaluate this, we're looking for a negative return on invested capital, and we're looking for a very, very large amount of capital expenditure. And the bottom line is we're just not seeing any of those factors. Right? The second thing that we have to look at is that many of these arguments in and around bubbles have to do with comparing current valuation metrics in the market to long-term average valuation metrics in the market. And the problem with that is you are comparing apples to oranges, because the indexes change. The indexes are not fixed. The largest stocks in the S&P 500 index from 10 years ago are very different than the largest stocks in the S&P 500 index from today. And the bottom line is that over the last 40 years, companies have really gotten better at being companies. We know that the profit margin has increased substantially since the 80s. We know that the level of corporate debt has come down. We know that profit margins are higher. And so if the quality of a business is higher and the debt is lower, they deserve to trade at a higher multiple. There is no way that, for instance, a company like ExxonMobil, which has a much lower profit margin than, again, Microsoft, should ever be trading at the same multiple. Microsoft should have substantially higher valuation than ExxonMobil. If it doesn't, then the market's is undervaluing Microsoft. So another thing when you're talking about these valuation arguments is that you have to look, if we look at the general market, right, we can see that NVIDIA trades at about 30 times forward earnings. If I look at my Refinitiv terminal here before I videoed. The bottom line is that Costco trades at 50 and Walmart trades at about 32 times forward earnings. So if NVIDIA is symptomatic of an AI bubble, then Costco is also symptomatic of a double bubble in shopping clubs. Now, I don't think either of these are the case to be true, but we also have to take a look around, and just because something's gone up doesn't mean that it's a bubble, right? And we also have to remember that returns recently have been strong, but nothing like what we saw in the late 90s. In the late 90s, we saw 2 years in the NASDAQ, where the NASDAQ 100, where the returns were north of 90% per annum. And we've had a couple of good years, where the S&P is up 20+%, is up in the mid-teens year to date, right? But it's nothing like what we saw at the going into the peak of the internet bubble. So again, we'll be watching out for that. We will be watching out for, again, valuations that do get detached. Again, if we take a look at the internet bubble, we do see that Cisco Systems went from 50 times earnings to 210 times earnings, or sorry, pardon me, 120 times earnings. And that is probably not justified. However, we're just not there yet. So the bottom line is we're going to look at the assessment. We're going to continue to assess based on current conditions, and we're going to take the right actions. But the bottom line is we just don't think that there's a bubble right now. The evidence just isn't there to support it. Okay, so in looking at this question about whether we're in a bubble or not, I actually want to put a different lens on things. I want to for a moment assume that we are in a bubble and maybe game out how long that this can go on for. Because bubbles are times of very high returns, and frankly, we do want to harvest as much of it as we can. When I take a look at things, the race in AI is really about a race towards artificial general intelligence. And those who gain the function of artificial general intelligence will be the winners, and those who do not are going to be the losers. And this applies to both nation states and companies. If the USA gets artificial general intelligence, China is going to look at that as a loss. If Meta gains artificial general intelligence and Google does not, Google will be out of business. So at the nation state level and at the company level, this is existential, and these companies and these nation states are going to fight for their lives by investing in artificial general intelligence research and development until either it's achieved or we determine that it's not possible. So the other thing we have to keep in mind here as well is that, especially for the United States, there's a huge incentive to spend because of provisions inside of the Big Beautiful Bill. Now, in the Big Beautiful Bill, until the year 2031, companies are able to deduct 100% of capital expenditure against current year income. So that generates an enormous incentive to upgrade plant, to invest in things, if you're in the AI world and data centers. But in general, it creates an enormous capacity to spend on capital goods to upgrade the economy. So there's no incentive either from a existential point of view or from a financial point of view for spending to stop. And I think it's important, with it to relay something that I had in a recent conversation with our very own James Thorne here, is that he pointed out to me is that Conrad, no bubble has ever popped because of valuations, right? Bubbles only pop when liquidity is withdrawn, when that extra money that's financing it is withdrawn. And so if we look at this to the view of an existential battle between very large companies that are very well financed and nation states, we're nowhere near the Cape point in which they're going to cry uncle, because we know specifically in regards to at the corporate level, they're only spending within cash flow. They haven't taken out any debt. All they're doing is spending their profit. And in terms of the nation state level, we are simply doing the exact opposite of withdrawing liquidity from the system. We know that the US dollar is down, the price of oil is down, interest rates are coming down, and the US Treasury is also inducing a lot of other policy changes that will increase the level of liquidity. In fact, we're doing the exact opposite. So again, even if we are in a bubble, we have to assess that currently it's probably got a long way to go, and we need to be watchful of it, but we also need to be there so that we can earn the profits. So there's one question I haven't answered, and that is, of course, the question left by the void of, okay, if we're not in a bubble, then what is the outlook at this time? So the bottom line is I don't have a crystal ball, and we are constantly assessing the way things look. But as it stands, based on the current evidence that I can see, I have to be positive, right? We have investor sentiment that is somewhere between pessimistic and skeptical, and that has always been positive for future equity returns, right? We know that we want to be greedy when others are fearful, and fearful when others are greedy. Or if we look at it through the lens of Peter Lynch and not Warren Buffett, we want to know that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So we've got a positive sign there. We have a positive sign from studies of history in the market, as well as studies of technical and quantitative factors. Those are all giving us the green light. And we also know that the general level of liquidity or extra money in the economy is rising, right? We know that the US dollar has dropped, which we've talked about being important to global liquidity. We know that the price of oil has dropped, and we've talked about that as well. We also know that interest rates are coming down, both in the United States and Canada. And those are two very powerful drivers of increased liquidity. And we haven't even gotten into touching on any of the policies enacted by the US administration and the US Treasury. They're all pro-liquidity. So with liquidity rising, the most normal thing is that the stock market and the economy are going to start to rise. And then that is in fact what we've seen over the course of the last 9 months. With the US dollar and oil coming down, as well as all the volatility around tariffs, we saw the US had a negative GDP print in the first quarter. And based on the Atlanta Fed GDP Now model, they're going to have a very, very strong positive quarter for the quarter ending in September. So there's no reason to think that that relationship, which has held through all of these seemingly odd times, is broken. So that gives us a positive signal going forward. None of these things are guaranteed, but when we put this together as a mosaic, again, I have to say, look, corrections are possible, but there's a lot more opportunity than threat out there, and we need to face that opportunity and make sure that we're taking advantage of it in alignment with your risk tolerance and objectives. Now, if you have any questions on this, we'll just leave off by saying, please give me a call. We are here to get the job done and happy to have a conversation around this in any level of detail that you wish. So in wrapping things up here for this month's video, we touched on a number of items, including a market update, a portfolio update. We talked about some estate planning pointers in regards to digital assets. And then we explored the question about whether we're in a bubble, and even if we are in one, what should we do? Now, if you have any questions on this or anything else related to your financial life, please pick up the phone, give us a call, hit that make a meeting button on the bottom of one of our emails. We're here to help and happy to have that conversation with you. Thank you very much for your trust and confidence, and we'll look forward with talking to each and every one of you very soon.